Now, how is the actual dividend preference that I'm talking about here? How does that limited amount, but having a priority position in terms of the timing of payout, how is that actually determined, this preferential right of preferred stockholders? Let's look at an example. In addition to 10,000 shares of no par value common stock issued at $50 per share, which was our last example, let's assume that we have issued 10,000 shares of common stock, no par value, at $50 a share, so we have contributed capital from common stockholders of $500,000. In addition to that, let's assume that our company issues 5,000 shares of, now listen to this, 7%, $100 par value preferred stock for $105 each. Okay, listen to that. 5,000 shares for $105 each. So the business will be receiving cash, and in fact we'll debit cash for $525,000, and we'll be crediting owner's equity, not common stock, but in this case preferred stock, for $525,000. The other thing to notice here is this par value. Notice that the par value on this stock is significant. It isn't 1 penny a share or a quarter of a tenth of a penny per share. I mean, the par value on this stock is significant. It's $100 per share. That is because the par value on preferred stock serves a different purpose. It is the basis for the preferential calculation of the preferential right to dividends. The 7% is the amount of the preference. So what I'm saying here is that the dividend preference for a preferred stockholder is 7% of $100 or $7 per year. $7 per year. Well, think about that. If you're an investor and you put in $100, or in this case $105, you pay a little bit more than the par value, and you receive $7. $7 of dividends on an investment of $105 is a little under 7% return on your investment, which might be better than a return on investment that you might get on bonds. See, this actually looks a little bit like interest, doesn't it, on debt? I mean, it kind of looks a little bit like that. You're putting in, and in this particular case, the total shareholders have put in 525,000 preferred shareholders, and they have a right to $7 per share, and there's 5,000 shareholders. That's $35,000 of preferred dividends every year. And to some extent, this 7% of amount kind of sounds like interest on a loan. But the difference here is that the company is not required to ever repay this it would look just like a loan if in fact the company was required in 2 years to repay this 525, or in 3 years or 10 years. But what distinguishes preferred stock from bonds or debt is the fact that the company never does have to repay the amount of the invested capital. Except if they terminate the business, then they must take whatever resources and pay back at least the par value if they have those resources available before the common shareholders get anything. Now here's a question. If in fact a preferred shareholder, these shareholders, owning 5,000 shares and putting in $525,000 of cash into the business and receiving $7 per share, which is pretty doggone good, of dividends every year, how do they ever actually get their money back? I mean, the $7 every year is great, but give me the $7 plus give me my $105 that I invested per share back, in a couple of years or 10 years or something like that. How does a preferred shareholder ever get that money back? Well, one way is they could wait until the business terminates, and upon termination, the company will take the assets, convert them all to cash, pay off the debts, and then pay off the preferred shareholders, at least to the extent of their par value, before the common shareholders get anything. So I could wait until the business terminates. But in most of these businesses that issue preferred stock, and many large publicly held businesses do, there is no plan for them to terminate the business. They hope they go on forever. So under that scenario, then how does a preferred shareholder get their money back? Well, the answer is that they can't get their money back from the business, but they could sell it to their roommate, to some other investor. I mean, let's say you put $105 into the business in exchange for a share of preferred stock. And you're owning that, and then you say, hey, I want to get my $105 back. If you went to the business and said, hey, listen, I own a share of preferred stock, give me my $105 back, they'd say, hey, no, I'm sorry, this was an equity investment. You're in it for the long term. When you provide money as an owner to the business, you're here for the long term of this business. I'm sorry, we're not legally obligated to give your money back. So what are the options of the shareholder? To go to their neighbor and say, hey, listen, I own a share of stock that has a preferential right to dividends every year equal to $7. And then you can sell it to somebody else, 10 years from now if you want to or something. And so, why don't you pay me $100, $105 or something dollars for my share of stock, and then you can collect $7 every year. This sounds just like a bond. But instead of it actually maturing and paying off, it just keeps getting transferred to other investors, and the company continues, hopefully, to pay $7 forever on this until it terminates, and then theoretically the money would come back to the investor. So not only on the New York Stock Exchange will you see, which is a secondary market for the trading of common stock, but it also accommodates trading of preferred stock. So you will see typically in the New York Stock Exchange listings, not only the trading and the prices of trading for common stock of companies, but also for preferred shareholders. But I should make this comment. The stock price for preferred stock typically is not very volatile. Because, hey, the reason why common stock prices increase significantly or may increase significantly over time is because of an anticipation of huge profits in the future, for which the common stockholders will be the beneficiaries of. But because preferred shareholders have such a limited right to the profitability of the business, they don't get to share in these huge increasing profits. They're limited to 7% of the par value every year. Then the value that the price somebody's willing to pay for that stock is probably going to be around $100 or so, probably more sensitive to interest rates than it is to the future huge profitability potential of a business. So common stock really provides for the opportunities for significant stock appreciation in stock values, but preferred stock typically does not. Many retired people on a fixed income will choose to invest in preferred stock because they're not interested in taking risks associated with appreciating common stock values that may actually go down also. They just want to get 7% a year investment. And so an investment in preferred stock may very well accommodate that kind of an investment strategy. Okay, enough of that. Let's do another problem. Make sure that you kind of understand, how this stuff works. And by the way, I don't know about you, but you may be exhausted. This lesson's going on here because it's great stuff. I mean, let's face it. I hope you're interested in this. I don't know. I am. To me, this is frankly a little more interesting than depreciation of property, plant, and equipment. We're talking about investing in businesses and what some of the tools are and stuff. So I think this is good stuff. This lesson's a little bit longer here. If you need to take a break, this might be a good spot to do it or whatever. But